previously in part 1. Today we're discussing the Great Pension IHT Shake-up, what April 27 means and what to do about it.
If someone's got an estate sizably over 2 million and that they add the pension in, they get past 75, they can pay both inheritance tax on the pension and then the recipients pay income tax as well. So I'm not a big fan of how it's come in.
No, but I think the more they meddle with pensions, the less confidence people have in them and less confident people are going to build up meaningful pensions. And if the government is trying to create an independent estate of civilians who don't have to rely on them for benefits in future years, they need to encourage this.
Their assets are way in excess of 500,000 for a single person. You're just asking for more and more tax. You're kicking the tax can down the road.
It's really redefining retirement planning and estate planning. It's really thrown a massive spanner in the works.
Let's talk about annuities and whether there's going to be a sort of resurgence of their popularity, not just after April 27 when these new rules come in.
We're certainly discussing annuities a lot more, and we're discussing the rates and the impact and the benefits and the pros and cons.
People are concerned about pensions coming into the estate and the inheritance tax implications. There are other things you can do to mitigate inheritance tax, one of which, the simplest one really, assuming you can get insured, is life insurance.
Nikki laughed because she thinks I've married more people than the local vicar. So the number of our clients who were single cohabiting who are now married, goes way in excess of 10, 15,
Welcome to the Finance Geeks, a podcast about real financial planning. If you're into numbers, strategies, and building a great planning business, this is your ultimate geeky hangout.
Just to explain it there to our listeners, the clients that you're working with that have got large pensions, they gift away the tax-free cash. They either don't want it, maybe it's a discretionary trust, bare trust, it could be any type in this example, they could just spend it. And they start taking drawdown, flex access drawdown to draw the pension to pay the protection. Which clients in that scenario, where are they getting their income from? Have they got DB schemes?
Yeah,
have they got big GIAs?
Yeah, various sorts. They might have multiple pensions. They might be drawing on the other pensions. They might have DB schemes. They might have rental income. Yeah. These are individuals that this money is purely earmarked for succession planning. Yeah. They've built up, they've got, for example, £1 million plus pension, and they're like, actually, I don't need that. I've shown them the cash flow. We've done it. And they've still got too much money. I'm like, enjoy this stuff. And
definitely.
Let's put it in perspective. These aren't like billionaires, okay? Yeah. There's a lot of individuals out there who live very comfortably within their means. The millionaire next door sort of scenario. They might just live on 30, 40, 50,000 pounds a year. Well, you get a couple of state pensions payable and a bit of DB schemes, a bit of other income.
You can be close to that pretty quick, can't you?
Yeah, really quickly. Yeah. And you got £1 million plus pension. Well, I just don't need it. A lot of our clients they don't know how wealthy they really are because they're just very modest, very humble individuals, work hard. They've put money aside every year. They've had some good guidance from people like us. And all of a sudden they're like, oh, wow, we've got a net worth of 2, 3, 4, 5 million.
But they're probably not associating success with just the amount of money. Success can be happy marriage, health, nice, great kids.
Completely.
Just not.
Yeah, completely.
It's
for some of them, trying to encourage them to spend and enjoy this money isn't enjoyable. Yeah, so you've got to back off a little bit. You've got to meet the client where they are and what's important to you. What brings you more happiness? And I think about one particular couple going to Norfolk. They love it. They take their dogs. They go to Norfolk. They send a B&B and stuff, and they have a wonderful time. And they are very happy individuals and have more money than they actually realize. Well, they actually know how much they've got, but they never will spend all this money. And they had normal income level jobs. They weren't like high earners. They just put money aside. Pound cost average, you talk about putting money aside every month, built the money up. Classic Millionaire Next Door, which is the book. It talks about this kind of thing.
That definition of as I say, of wealthy or rich or whatever. There's no simple definitive, right? This is what it means. This is the amount of money you have to sort of resolve and to become financially independent. It's very independent. It's very personal. Interesting though. You just mentioned there about the state pension. We know it's about £12,500 a year for those receiving it since around 2016, since the flat rate came in. 25,000 a year each.
We've
it's been talked about again by politicians that the triple lock will need to go.
It needs to go.
Yeah. So if Britain do both reduce the welfare cost by making it better for people to work than not work, encouraging work, creating jobs. Even Adam Smith said it's better to have someone dig a hole and fill it in and do something and feel good about it than it is to sort of
really?
It's the classic. What do you do with spare capacity? What do you do with people that if you want to give them a job but don't have one? Anyway, it's an analogy. Getting rid of net zero and the costs associated with that is something the UK has got to do, according to this is all Tony Blair. So take it with a pinch of salt, but it's sensible because we talk about money in, money out, and budgeting. And it's the same for a government. They have to do exactly the same thing. You get so much money in, and you get so much money to spend.
At it. They need a good bloody financial planner to
Again,
look at their budget.
Not getting political. It reminds me of that film Dave with Kevin Kline. They can't work out how to pay for something. He said, "Let me have a look at it." And he gets his friend in as an accountant, and then they work out how to balance the budget to bring this welfare proposal back into it, and just do the numbers. And obviously, it's a bit made up. Okay, so one of the things that I found that I've been doing more is encouraging clients to draw additional monies. And we just talked there about it's not as easy as it sounds, because to turn on the tap and to start receiving it. So you could alter your spending budget and redraw it up and say, these are my costs, this is what I could afford to spend, and learn to feel good about it. You can draw additional monies randomly from a pension. Yes, you might be paying tax on that taxable income, and say, right, what I'll do is I'll start gifting some of this money. I'll use the gifts out of ordinary expenditure rule to gift money to my children. I'll top up their ISA, their GIA, and there are ways to do it. You can't put it directly in. You've got to give it to them, and they put it in. And but grandparents can pay directly into children's junior ISAs. So that works quite effectively. And Transact, what's great about them is you can move money between GIAs internally within the platform and then top up various pots. So if your motivations are to sort of enjoy your money, knowing that you're not going to run out, and if you don't need it to spend it yourself because you just nothing to spend it on, then you can gift it to your children. You could gift some to charity. And this discussion about mitigating inheritance tax, it's had far-reaching implications, because as well as whole of life and changing the death benefit nominations, for a lot of our clients, we've been talking about updating their wills to consider the 10% gift to charity of their net estate, to reduce the IHT rate from 40 to 36%. I've done that myself. My wife and I both chose two charities.
Let me jump in on that one. Two things. One, I think it's really important that you leave a fixed amount to a charity as opposed to a percentage. And the rationale behind that is there are so many real life stories. You've just got to Google it. I think Moneybox did a program on it, of charities really making it hard for the executors and making them get valuations on this, that, and the other. They really do get their 10% worth. Which in the scheme of things, you kind of think that's really unreasonable because they're receiving a gift. Yeah. But I guess on the other flip side, you look at it and say, well, these people are representing the beneficiaries of that charity. It's their job to make sure that they're getting their valued money for worth. Yeah. And the second point really is, one of the things that we do is I won't say rarely, but I'd say the majority of our estate wills, our estate planning, our wills for clients, leave the residue of the estate into trust. Again, just like the pension, we're trying to move money out of the estate. You can instruct or guide the trustees to give 10% of your estate to charity, and although the money goes into trust, it will still benefit the same way.
I think that perhaps there's two things. There's the trust, there's giving money to a trust or to a charity at the point of death, but there's also the lifetime gifts, where there's a client that I work with where they're going to set up a DAF, a donor advised fund, because they've got taxable income of £100,000. You can effectively pay 100,000, get your marginal rate of tax back. It's actually 20%, not the 40. The charity gets another 25% on top, so it costs 80 to put 125 in, and that money is outside of the estate on day one.
Yeah.
So if you want to be able to decide who gets what when, these various charities, donor advised funds for those with too much in assets can be a good option.
I know we're talking about pensions. Let's just spend 1 minute on that. So a donor advised fund basically is a charity account, but it doesn't nominate a particular charity. So CAF, Charity AIDS Foundation, is the main one in the UK. You put your money into CAF, it sits into a bank account, and then you decide at any time in the future when you actually distribute that money to charities going forward. I've been on at Transact for ages to run one of these. I think Transact should have a donor advised fund that we can just use via that. What we've done with few clients, so we've not done it very often, is set up their own family trust, charitable trust. So they have their own foundation, and they can do it themselves. They can control it that way.
That's the sort of next level up, isn't it? You're like a mini Bill Gates foundation. Obviously, he's got a few more quid in there, and deciding to which registered charities you're gonna give the money. So going back to pensions, we talked about. I just mentioned then there's this idea of encouraging clients to make use of the rules, to draw it out, knowing that it's better to have the money now, in a lot of cases, pay the tax now, the income tax on the withdrawal, and do something with that, and deliberately and intentionally withdraw monies from the pension. And what this really means is that the order of withdrawal is it might be changing, because quite often clients might retain some cash. They might sometimes, if they've got a lot of cash, say, well, I don't want to touch my investments yet. I'll just touch the cash. And they're not setting up that strategy of withdrawal from GIA, ISA, pension, offshore bond. And it depends on the size of those individual pots. You do get bizarre scenarios where a client's got $500,000 in an ISA and only 100 grand in a GIA, and they've got this 500 grand pension. And normally the pension's the biggest pot. And then ISA might be the second and GIA is the first. So it used to be sort of GIA first, then ISA, then pension. And the order can change depending on their circumstance. I wouldn't be surprised if we see capital gains tax rates changing in the future, back to 20 and 40 as it's been in the past, rather than 18 and 24.
We're not drawing on pensions yet for the sake of it, or changing the order of spending, just in case something happens to the client before April 27. Yeah, we are, for those people not touching that or had no plans to touch pension. We're doing what I explained, doing that way. But if someone's got an ISA and someone has a pension and they're drawing on their ISA or a GIA, we are keeping that strategy. But come April 27, you're right, we will be changing it, particularly for those clients who are closer to age 75. There's not, I think, for the advisor listener, there's not just one way of doing anything. It's got to be a relationship with the client, what's most important to them. But you've got to emphasize, as they get closer to 75, the income tax rules change on the pension, plus the inheritance tax. It makes it very, very unattractive.
And absolutely right. Listen, all of that, I agree with the each case on its merits. And this is another thing that I've talked to seminar and webinar sponsors, big conferences about. There's not enough practical day-to-day discussions, for my money, on from advisors explaining this sort of thing with a PowerPoint presentation on stage, in person, doing it together with case studies. Because you unless you're an experienced advisor and you've dealt with clients of different ages, different health, different situations, different size of assets, the advice changes. And it's down to personal preference as well, and lots of things. You get bizarre scenarios where, and it's not particularly nice to deal with, but clients are early 60s, parents in their 80s. They know they're going to inherit a ton of money. So they're intentionally misspending all their money now, knowing that they're going to get an inheritance tax. Now, it's a bit of a risky one, that, because if your parents change the will and it all goes to charity, or they live to 220, it's going to go, oh. So I'm not sure that's always the best way of doing it. More and more, the more complicated this scenario, the bigger the pots of money, the more the requirement for advice. And it absolutely is where the advisor demonstrates their value, because once you've got the basics sorted about what they've got and how they can draw it and how much they need, you can then tweak it, of course, to say, well, let's model these scenarios based on what might happen in the future. You might downsize and release additional monies. You might get this with a bonus or inheritance or sell a buy to let or whatever. Yeah. Have you done a lot of intentionally drawing the tax-free cash out of pots now, rather than waiting?
Yeah, but mainly for those people who have no plan to spend the money. So for people who are going to use that pension for their income in their retirement years, so when their earned income typically stops, then no. Because our preferred strategy typically is fully in cash in segments of the pension rather than doing a drawdown.
It used to be the case, didn't it, with the old rules on pre and post crystallized and uncrystallized benefits, that you would crystallize a bit at a time. Now, especially with having a good year, if you're going to do it, it's a right faff crystallizing a bit at a time. We generally just do all of it.
Your question was about the gifting the tax-free cash. For those people not needing the money, yes, we've done, I think everyone now. I think everyone and we know our clients very well. Those people aren't going to use their pensions. We've actually crystallized the pension. We've gifted that off into trust, so the 7-year rule starts ticking straight away.
Yeah.
And then we are now sort of drawing the income for most of those people, not all of them, drawing the income and buying the insurance product, which is obviously written in trust. And then those people that are going to use their pensions for income, what we'll do is we'll run up to early next year, and then we'll swap and we'll take their income from their GIAs and ISAs, and then take their income from their pension and defer their GIAs and ISAs.
Yeah, there's an argument to crystallize the whole pension, knowing that it's probably done pretty well over the last 12 months. And if they're close to the maximum, the 268,275 figure, take the money out. With that, sometimes we've topped up cash, sometimes intentionally paid off mortgage, although lots of our clients don't have mortgages. And then other times when they do actually need the money, they don't want to give it away, we've taken out the pension to put it in an offshore bond. And it might be, it's a little bit premature to sort of do those things, but at least the 7-year clock's running earlier. If you put it in trust, you're moving it from a more complicated scenario, arguably, with a pension into an offshore bond. Because if they want to draw 4 or let's say 5% tax deferred income from the bond, it's quite a nice figure. You put 250,000 in, you draw in 12.5. It's about 1,000 a month. You don't have to put it on a tax return. They're drawing this 5%. It's not outside of the estate. It's just in an offshore bond. But at least then you can use the rules of offshore bonds and sort of pass segments over and so forth. And I quite like the idea of doing it earlier, because if you do it 5 years before the normal time when a client wants to draw benefits, or even 7, you've got those 5 years each of the original investment amount, so 35% of the original lump sum that you could draw out as a lump sum. And at least that way, you've not got the implications, especially if you're of pensions and worrying about inheritance tax on second death.
It's interesting. We do that way, but the majority of the time when we take money from an offshore bond, we'll do full crystallization of segments. So they get a bit tax free, they get a bit of taxable income. Do that way. Yeah. The rationale for us, and it's not right or wrong, it's just a different way, and that's why I'm raising it, is that we're not kicking the tax liability down the road. So 20 years later, you do that everything's taxable. So what we've got is just a segment process, really. Every client's different. Sometimes their income is such level that you just want the tax-free return of capital.
Yeah. So conscious of time, so let's just talk about the what we call the big wait and see caveat. There's the case for acting now before April 27, and the case for caution, which we've talked a bit about both. But we're just going to go through some of the, to clarify and to confirm some of the cases for acting now and some of the things that you can actually do. So do you want to kick off, or do you want me to start?
You carry on. I'm looking at it. Yeah, so it's good.
So the case for acting now, we've got that 7-year gifting clock starting, for taking benefits. The expression of wish is free to fix today. You can alter that accordingly. There's work to do there, I think, to make it clearer. You can spend and enjoy the money rather than regret it. And it's a big thing for me, that rather encouraging clients where the position shows, the cash flow shows that they can afford to spend it now. Their health is better now than it will be in 5 or 7 years' time. What are you waiting for? And I asked that question when I did that presentation at Advisor 3.0. Are you living your life, or are you planning to? And it's
a good question.
Always pushed off. The last two, before we go into the case for caution, is annuities are becoming perhaps a bit more popular, and the decision, it takes time to actually decide on which is the best option, but discuss, at least if you're an advisor, the options of annuity with a client with some or all of their money.
Yeah, I agree.
And these frozen allowances of essentially the tax-free cash level being fixed now. It's not 25. There's no lifetime allowance. It's the LSDBA, isn't it? fixed element of tax-free cash. I have clients where they've got sizable pensions, 700, 800, 900,000, and they're still in their 40s, early 50s. But with organic growth alone, they'll be way, way over the old lifetime allowance, and therefore they're maxing out their tax-free cash. And you get scenarios where employers, people are earning good incomes, and people are caught by the tapered annual allowance rules and the how much can they pay in, and it becomes really quite testing
when you said earlier about are you living your best life or are you planning to, it brought me back to going to see Lords with you. And we were living our best life.
Thanks.
We lived it up. We had a great time.
Well, that was another top tip, isn't it? Is putting dates in your diary. That's my top tip for everybody listening to this episode today. Pensions are a bit boring, but get advice on them. But they're necessary evil for a lot of people. And yet I just keep getting emails through, whether it's Royal Fane, which is all tickets, Royal Albert Hall, going to watch cricket or tennis or whatever it is. Not the football. I'm not going to travel to America to watch football and pay $20 for a beer over in America. Forget that. Right, the case for caution. We know that it's got royal assent, but it's possible that the rules change before April 27, albeit I don't think so.
Yeah, really, possible, but unlikely.
And if you're working, second one, yes, you can take the tax-free cash and take 0% from the Flex Access drawdown pot, the remaining pot. But, you are going to trigger income tax if you start drawing income from the pot and drawing it out. And what you don't want to pay is too much tax unnecessarily. There is this time period for a lot of people between when they stop work and they start drawing from their assets and when they receive their state pension. And if it's 7 years from 60 to 67, for example, you've got those 6 years where you can draw at least 12,570, the personal allowance, from the pension. Even though it's taxable, there's no tax. It's worth doing it. Because if you don't use the personal allowance, that's it. You've lost it. It's like not using your CGT allowance. You can't go back, or your ISA allowance. Gifting too much risks the client's own security. I'm all for gifts and reducing tax and liabilities and helping people who need it, kids onto the property ladder and stuff. But you do get scenarios where parents give too much away to risk their own future security.
We have an acronym which we use with our clients. We said let's secure our now, then, them. So you are current now,
nice,
the future, and them. Look after the other people.
So if you take out our money now, you've got the lost tax-free growth because pensions still grow free of income tax and CGT inside the pension, and that's very attractive. And then it's the classic knee-jerk reaction. You can't just undo it. If you take your tax-free cash, you can't put it back. We do get clients with sizable ISAs that need access to monies. And what I like at this time of year, June, you've got another 9 or 10 months before the start of the next tax year. Transact ISA is flexible. You can draw it out and put it back in and not affect your allowance. So done a bit of that. So is there anything else in terms of closing thoughts or what clients can actually do, Mr. Shute?
I think the main thing is to get things reviewed. Look at, are you likely going to use your pension for your retirement needs, or was it an estate planning vehicle, i.e. it's grown beyond your expectations? If it's grown beyond your expectations, then you really should be doing something about moving it out of your estate now, whether that is taking tax-free cash and gifting it, taking the income and gifting the income into trust outside of your estate. You don't have to buy insurance. So you're doing something with it to move that money out of your estate. Because come post 75 and after April 27, it's massively taxed, and it becomes theft, if I'm honest, which I think is, from the government. I think it's ridiculous that they've got it, but hey, we won't get too political. But if your plan is to use your pension for a retirement vehicle, then I've got to be honest, I wouldn't really be doing an awful lot different. I wouldn't be doing much different right now. I think come April 27, there's an argument around using the pension money more heavily than the ISAs and GIA. But I guess we're closer to April 27 now, we just under a year away. So the damage or the impact of drawing that, what I'm looking at is if you died before then, the IHT implications, your pension's out of the estate.
Yeah, it sort of largely depends on your family situation, your age, your health, lots of these things. So if someone's younger and they're married, if they're only 55 and they're married, you don't really need to do that much. You don't really need to take action now. premature to sort of say, oh, I need to take my tax-free cash. And do you remember there was that time in the past where we thought tax-free cash at a budget was going to get removed, and I had a couple of clients take money out because they thought, oh, they're going to get rid of it, and they never did.
I don't think we thought that, but clients thought that.
Yeah. So the next thing is to fix the free stuff. I think I would encourage advisors listening to this to speak to their clients, and if you're a client, speak to your advisor about reviewing your expression of wish, deciding on who you want your nominations to be, who you want your trustees to be. Update your wills. If you email me or get in touch with us on one of the links, I can send you our guide to how to put together a will properly. It's an 18-page guide. It's very thorough. And there's very little cost in updating. I mean, there's no cost to change your expression of wish usually at all. There will be a cost to update your will, but it's a low cost for the impact of it. And we're talking here about knee-jerk reactions to mitigate inheritance tax. This is the thing. Pensions coming into the estate, and inheritance tax mitigation is the name of the game, which you can do in other ways. So using the spousal exemption deliberately, making sure on first death you don't waste it goes to the right person, there's no IHT between spouses, and then what I'd encourage people to do as part of that is to say, well, how much does my spouse need of this pension? Because you could absolutely have children or grandchildren, pre or post 75, be one of those listed beneficiaries. And you could give additional rules to the master trustee, which is Transact, to say what happens if, because otherwise they'll just use their own discretion. And so that's why I've encouraged the powers that be at Transact to elaborate on that form, on the expression of wish, to include more of the scenarios.
Yeah, good.
Gifting more and giving while you're living, using the annual exemption, gifts out of normal expenditure. That's a good way to mitigate IHT, what's affordable. And I think when it comes to things like annuities, I mean, they are, I'd say, in the minority of what a lot of our clients are. We don't do a lot of them at all. We've had one or two clients want them and we've set them up. That's fine. But it's horses for courses with a lot of that. The last point was just to stay calm. Stay calm. Tell someone to don't panic, and just realize that there are options. The rules aren't even live yet, but you've just got to look at your options, get advice, and make decisions that are right for you.
Hey, shall we wrap up for this double episode? And do you have any Q&As for me?
With a bit of Q&A, I do. The which one do I like out of all of these? I'm not going to do that Bill Perkins one. The goal's to die with zero. I mean, is that the goal?
It's interesting. Bill Perkins. So, was it Jimmy Carr? One of the audience members. He does Q&A, and he said, the question was, what financial advice you got for me? And he said, well, read Bill Perkins, Die with Zero.
Yeah, he did say that.
And read Psychology of Money.
Did he say that? Morgan Housel? Yeah, very good. It definitely is a good book. I refer to it a lot, I think. Okay, so I'm going to give one here from Warren Buffett. I do like this one. He said, I want to give my kids enough so that they can do anything, but not so much that they can do nothing.
I agree with that. Because I think there's a couple of things in that. I think creating the effort of work builds character, and it's just like you were saying, Adam Smith saying, dig a hole and fill it back in. There's character building. It's good, to do it.
People can have a purpose for sure.
You've put it down here, but this is one of my favorite quotes. The best time to plant a tree was 20 years ago. The second best time is now. And I use that often because I think it's so easy just to mañana, put off for another time, and we'll get around to it, kind of thing. And
that refers to a lot of things, doesn't it? Whether it's the gifting, the 7-year rule, the investing, to get on with it now, to sort of
taking
just get in the market,
holiday,
just do it,
buying that bottle of wine, whatever it might be, the things that bring you happiness.
Buying that bottle of wine. Hey, like that 2 bottles of wine that we bought when we went to that fancy restaurant.
That was nice.
They were lovely wine. I shouldn't have got that second one, and it was bloody expensive, but it was probably worth every penny.
It's like, come on. Just think of it. You had a 40% discount because you're not going to pay IHT on that money anymore.
Oh, that's the way to look at it. I love it. And a corp tax bill, because we were talking about work. Got work to pay it. The classic Benjamin Franklin quote, in this world, nothing can be said to be certain except death and taxes. And we just have to live with that. We're not going to live forever, and we're always going to pay tax. But,
absolutely.
try to pay a bit less of it. Pay enough.
Is that a wrap for you today?
That's a wrap, Warren. Thank you. Yeah.
Thanks for tuning into the Finance Geeks podcast. That's a wrap for today, and we'll see you in a couple of weeks.
Okay. Thanks, guys. See you now.
Thanks for tuning in to the Finance Geeks. Don't forget to like, subscribe, and leave us a 5-star review. Drop your comments and questions on YouTube, and be sure to follow us on social media. Join us next time for more insights to boost your financial planning game.